If your tokenomics suck, it doesn't matter how good the product is. Now, the reason for that is because if your token's price performance doesn't impact your product, then you have a useless token. And if your product doesn't impact your token, then you have a useless product. Now, if neither of them are useless, then that means that one will very greatly impact the other. And the key part in making sure that you have good tokenomics is your fundraising tranches, because that's what you use to go to VCs, and that's how the VCs invest, and it's just very important. Now, there are 8 key parts to the fundraising tranches, and it's all like a puzzle. They all interlock together. If you change one, you have to change the others. So today we'll be explaining how all of that works, and fundamentally, you'll probably be able to start your own consultancy, your tokenomics consultancy, after all of the alpha that I'm going to drop today. So without further ado, let's get cracking. Now, the first thing is your valuation delta, as I have over here written already. Now, the valuation delta is the difference between the different rounds for investments. For example, we have seed at $50 million, we have public at $100 million. That is a difference of 2x. Now, typically, you want to go for 3 to 5x from your earliest round to your latest round. Anything more than that, and the incentives are misaligned. Like, for example, if this was a $10 million valuation, now that's a 10x delta. Now, what this means is when the token launches, the seed investors are already at a 10x. That's not good because they will instantly dump the token because they do not need to wait any longer whatsoever. However, the public round, your launch pads, they're simply not going to go for that. So you want to make sure that the valuation difference isn't, more than 3 to 5x. So this can realistically be, let's say, 30 million, and we are okay. Now, you don't want to have it too low either, because if it's too low, if this is, for example, 0.7, as you can see, that's not very appealing to any investors in seed round, and you'll probably be unable to close that round. So you want to make sure that it's somewhere balanced and somewhere in the middle. Now, the second part is your TGE unlock. Now, this is very simple. It's how many tokens get unlocked at TGE, and typically it ranges from 0 to 20% for the investment rounds. So, for example, here we have 5% for seed, 10% for private, 20% for public. Now, this is where the relationships really begin to showcase, because if you have a very high valuation, like for example here, it's a decent size, but let's say you already sold to them at 0.2, at 20 mil valuation, that's a 5x, right? So, or, to listing, that's a 5.5x, because this is the actual price that we'll be listing the token at. If the delta in valuations is quite high, like for example here, what you can do is reduce the amount of unlocks at TGE and increase them for the other tranches to balance things out. Number 3, the cliff. Now, the cliff is just the duration, until any tokens hit the market after the TGE unlock, and it's typically between 6 to 12 months for investors. And as we can see here, the earlier the round, the longer the cliff, right? For seed, it's 12 months, for private it's 9. For public, it's your launch pads, typically it's 0, it might range to 1 month, 2 months, whatever, but it's normally quite low. Depends on, of course, how many tokens are being sold, and again, the delta to the listing price. Now, this is great because it delays any sell pressure. So the longer the cliff, the more sell pressure is delayed. However, on the flip side, it might be very unappealing to investors to invest. So you need to make sure that it's pretty balanced. Now, number 4 is the vesting. Now, keynote, vesting generally refers to this vesting and the cliff. However, here we're splitting it up for ease. In essence, vesting is how long it takes for the tokens to come out after the cliff, and it's typically between 12 to 36 months, depending on the tranche once again. So for instance, here we have 24, 21, and then 6 months for the launchpad round, which is of course very different to the investor rounds. But as you can see, once again, the later the round, the shorter the vesting, the higher the DG unlock, and it's all because they're getting in at a higher valuation. So we're keeping things balanced, where the TG unlocks, the cliffs, and the vesting schedules work together on an inverse relationship to the valuation. So what's next is, well, again, the longer the vestings, the better for you because there's less sell pressure, however, less appealing to investors. But also, if your project is very good and the investors are truly long-term VCs and they believe in it, they wouldn't mind longer-term vesting. Now, number 5 is the initial market cap, or the IMC. Typically, well, the IMC is simply the amount of tokens that you have unlocked, as you can see here. The amount of tokens that you have unlocked multiplied by the token price. Now, typically, it is between 2 to 25% of your fully diluted valuation. And the reason why is because the lower side projects that have a much lower initial market cap, they want to pump on launch. They want to have a very restricted amount of supply on launch so that when people buy the token, the price shoots up. The problem with that is as soon as other tokens start to enter the market, that price, that valuation that they skyrocketed to, becomes unsustainable and the price starts to dwindle back down. This is the low float, high FDV problem. Float meaning, or being a more accurate depiction of circulating supply, which doesn't include things like staked tokens or locked tokens. Now, of course, that problem in and of itself doesn't really exist. It's a fugazi. We looked into, have a whole article on it. There's no coins really that are low float, high FDV. It's just, it's made up. It doesn't really exist. But regardless, the problem itself is fundamentally true. You want to have a high enough initial market cap so that there is sufficient liquidity so that your token price doesn't just fly up or fly back down. But the more tokens you unlock on TGE, the more sell pressure you're going to experience. So it's a fine balancing act. Now, number 6, your FDV, your fully diluted valuation. Now, this can range from 0, realistically, like a pump fund token, or it's like 100K or whatever, all the way up to, billions of dollars, right? Like maybe 1 to 2 bill, 2 bill, 3 bill, whatever. Of course, the higher valuation, don't buy into that bullshit. But typically, reasonable projects, they range from, let's say 5 mil to like 50 mil or so. Right? This is kind of like a more fair valuation. Even this, however, is just not really right. Like most projects can't uphold $50 million in value, right? You just don't have enough users. To uphold $50 million valuation, you need to have millions of users, right? Or whales on board. Like a product needs to be institutional and you need to have whales on board. So generally speaking, a much more fair valuation for projects will be between the 5 to 20 mil range. For the vast majority of projects, because they have tens of thousands, maybe even hundreds of thousands of users, that is not millions of dollars of token value, right? It just doesn't make sense. That is why all of the tokens collapse down to valuations in the 7 to very low 8-figure range. So you may as well launch there, because then your token price wouldn't look like that. It will simply look like that, which is completely fine. Anyways, your fully diluted valuation. This is where it gets a little bit more tricky, because the higher your fully diluted valuation, the more money you can raise. So yes, there is a lot more sell pressure happening because each token that is being sold is simply valued more. So there's more sell pressure that you need to uphold, but you can also fundraise more money. So for example, in our case here, let's say we're going to be listing instead of at $1, let's say we're actually listing at $1.10, let's say we're listing at $11. Fully diluted valuation of $1.1 billion. That's very high. Now, because of the fundraising delta point earlier, we need to make sure that the other rounds are balanced, right? We can't really have a valuation of 30 million, 75 million, 100 million when our fully diluted valuation is 1.1 billion. I mean, you can, of course, that's what happens with some projects. Like for example, with Sui, the earlier rounds were pennies, and then it listed at like $1, $2, depending on the exchange. So mental, right? Absolutely mental. Those VCs have delta to listings, like 100, 200x, whatever, some of them. Now, of course, that's not really feasible for most projects. But the main point is that, again, these guys will just dump. They'll just dump as soon as they have any tokens in the market. So you want to make sure that you're playing the cards right. And let's say this can be $3, this can be $7.5, this can be 10. Now, what you've noticed is we're raising a lot more money. We're raising $162 million now instead of 16. Now, this is why the valuation typically is very high for projects, because they think, oh, I'm going to make my valuation super high, and therefore I won't need to, I'll be able to raise a lot more money. That is, of course, a bad idea, because again, your token price will just collapse. So you might raise a lot more money, sure, if you're a good enough project, but let's be reasonable and make sure that your token price doesn't collapse, unless you're one of those blue chip, like ex blue chip kind of founder who has so many good contacts with tier 1 VCs, and you can just have a token that launches at $1 billion valuation, and you can uphold it because you have all the whales that are just buying and holding your token. You have so much money for marketing, etc. So be reasonable, because you're probably not like that, and even those projects are just massive scams like Mantra or now the other project with a very weird ticker, what's it called, Polyhedera, right? So, you know, let's see what happens. Anyways, so FDV, that's point number 6. Point number 7 is allocations. Now, allocations typically to investors, you know, you don't want to go above 25%. So generally speaking, with allocations, for example, if this was our allocations pie chart, this is the rough split that you want to have, where 25% of it is to VCs, 25% of it is to insiders. So for example, the team, the advisors, partners, whatever. 25% of it is to ops, so like liquidity, treasury, and then 25% of it is to community. Now, of course, this is all very case by case. Typically, community get, you know, a lot more. They maybe get like up to 50%, maybe in some projects even more so. But generally speaking, all the way through, VCs should not get more than around 25%. Otherwise, it's just quite a lot that they're giving. It doesn't really matter because they can be allocated 100% of the tokens, right? If there is enough buy pressure in the market to sustain that sell pressure, then it's fine, because then you eventually just pass ownership over from investors all the way down to the community, because the community will be buying the tokens. The problem is the optics of it. It just looks quite bad if 100% of your supply goes towards, you know, investors, right? So in this case, we have an allocation of actually 27% for investors, but you know, it's on the higher end. You realistically don't want to go more than like 30, right? Absolute limit. But under 25 is better. Under 20 is ideal, right? And then number 8, the final one, is your fundraise amount. Now this is something that we kind of already covered before, and it's a function of your fully diluted valuation and, to be honest, everything else. But the fundraise amount is more of a subsequent, right? Because how much you need to fundraise will impact all of these things, and all of these things will impact how much you need to fundraise, right? So it's a kind of macro objective here. Now let's run through an example and showcase all of these data points working together. So we have Simcoin. You have 100 million tokens and you allocate 10% to seed at a valuation of, let's say, $50 million. Now, the TG unlocks, as we can see here, are 5%, 12% cliff, and 24% monthly linear vesting. The private round, of course, needs to have a high valuation, say 75 mil, so that's fine. However, you need to sweeten the deal a little bit and give them slightly shorter vesting schedules. So you give them, you know, 9-month cliff, 21-month vesting, and slightly higher TGE unlock. So let's say 10%. So that's already covered, right? However, now you realize that actually your initial markup is a bit high. Excluding liquidity, this is quite high, right? And maybe you want to have a low initial market cap so that you have a bit more of a price pump on launch, and you want to uphold that via some buybacks or, you know, some interesting marketing schemes that you have going on. So you want to reduce the initial market cap, and what you decide to do is reduce the total allocation given to investors. Let's say private down to 10% and the seed round down to 7%. And as we can see, the initial markup went down by a relatively decent amount. However, now you're not raising enough money, right? Because we reduced the allocations, you're not raising enough money. So what we can do is instead increase the allocations once again, however, reduce the private TGE unlock round to 5%, and let's say the seed round down to, well, to be fair, that already kind of does the job. So in order to sweeten the deal, however, you can reduce the cliff a little bit more. Maybe we can reduce it down to 7 months, or maybe even 6 months, because the TG unlock is now the same. So you want to sweeten the deal a little bit. But now you notice that your allocation to investors is above 25%. As I mentioned, not a big problem, because you know it's still below 30, which is kind of the absolute limit, I would say, but very case dependent. Some projects are 40% to investors and it's fine, right? So this is super, you know, averages. You want to bring it back down to below 25. So what you can't do is simply reduce the allocations, because then you're not raising enough money. But what you can do is reduce the allocation and increase the valuation, and therefore we are raising practically the same amount as we were raising before. Right, so we go from 18.25 to 17.4. Maybe we can increase this even higher. Maybe we can actually increase the valuation here as well of seed. There we go. Okay, maybe make even more so, raising even more money now. So the allocation has reduced, but now the valuations are higher and we're raising more money. However, now the delta between the different rounds isn't that appealing. It's very close together and it's not appealing enough to investors. So what you want to do is increase the fully diluted valuation, let's say down to up to 150 million. And now the deltas are a lot more reasonable. Still not the most appealing, but at least a lot better and easier to sell to VCs. However, you notice that now the valuation is actually too high and you'll very much struggle to uphold it. So what you decide to do is bring this back down to 110 mil as you had before, and you simply accept the fact that you're not going to raise as much money because you'll bring this back down to what it was before as well, and you simply finish the raise with an NFT sale. So all of that hopefully made some good sense, and hopefully understood the relationship between all of these different tranches and all of the different points and how to navigate everything. And you know, it is a bit of a science and an art. However, the good news is you don't have to do this yourself. We can help you out. We've designed tokenomics for more than 100 projects at this point, whether it's just the tables, whether it's the full economy with the supply side table here, or you know, whether it's just advisory on the tokenomics tables that were already created. And we've done this for all the different narratives. So feel free to message us. There'll be a link to my Telegram in the description and an email. Feel free to reach out and we will definitely help you with your tokenomics. Make sure that it's structured so that it's appealing to VCs, so that it doesn't create too much sell pressure, so that the market conditions are factored in, and so that everything works nice and smoothly. Thank you very much for joining, and hopefully this was a useful session. Stay tuned for